Good morning, good afternoon, wherever you are. Welcome back to Markets for Millennials for the weekly market analysis from June 13th through the 17th. And for this video, what we're basically saying and what I'm titling this is that the Fed wants a recession. And obviously, that's become abundantly clear. But uh, over the last week, on Wednesday, we had the FOMC press release and the um, Federal Reserve Chairman Jay Powell coming out with his press conference in which he essentially tried to deny that the Fed is inducing a recession or trying to have a recession. But in reality, um, I think we all understand, or if you have any sort of pulse on the markets, you understand that the only way to really bring inflation down, which right now is the Fed's only mandate, the only thing that they really care about doing in this particular instance, which is to bring down inflation. And so, what we're going to do today is we're going to take a look at the impact that that's having, and we're going to try to make sense of all of this and what's going on. Obviously, there's a lot of other news. I just want to take a brief gander here at this chart of the Japanese 10-year Treasury, the yield, and obviously the Japanese have been doing yield curve control for some time, and they had come out in the last few months and really asserted that they were going to try to keep their peg around 25-ish basis points. And what I did here is I took uh, the the yield, which is in white, and you can actually see kind of where it levels off, right about here. And so that's definitely the period of time in which they were talking about their commitment to keeping that yield right there. And what I did is I overlaid the USD JPY currency chart, and I stuck it over, or I inverted it so that you could see um, essentially as the blue line goes down, that's showing you the value of the Japanese yen versus the US dollar um, declining. And you can see the cost of the Japanese yield curve control policy. And actually, in the last 2 days, you actually see too that their peg is breaking. And if they continue to commit to keeping the peg and buying an unlimited number of bonds, then you can just imagine what could happen to their currency. That's another big thing that's been going on. Another big thing that's going on. And as of the time of recording this morning on Saturday morning, you can see that Bitcoin is uh, headed down below some key price levels. One of the biggest things being that Bitcoin has now traded below its 2017 high, and so there's a lot of crypto madness out there, a lot of contagion with the um, different things going on out there. With obviously we had back here in early May we had the Luna collapse. We've had multiple other companies going insolvent or uh, selling off assets in order to try to uh, keep their business going. Just a lot of leverage being flushed, uh, you know, a lot of cross collateralization. I don't really know if that's the right way to describe that, but those are some of the big stories from the week. But what I want to start off with here today is on the analysis is looking at the S&P 500, the Nasdaq, the Dow, and the Russell, and looking at how far we've fallen. You can see I've got this price box. I'm on a 3-day chart right now, so you can see kind of the big picture. But what we're looking at here is a price box that is marking the daily high, closing high, to where we have closed at the end of this week. And on the S&P, we are down 23.2%. So bear market for the S&P, which confirms again having a bear market in the Nasdaq and in the Russell. The Dow is the only index that has not dipped into bear market territory yet on a closing basis currently. Just a shade under 20% drop at 18.56 as of yesterday's close. But what I've done on all my charts is I've kind of turned back on these lines or these boxes, these colored boxes. And then what I also did was I marked the pre-COVID closing daily high on the chart. And the reason for this is that I want you to see kind of the various levels that we could be coming back to and that we have come back to on particularly a few of the charts. And so The reason why I put these boxes is because I was marking the back in 2020, the end of August, beginning of September, and then also in October, and we kind of had these two 10% corrections, and we kind of bounced around in there right before the 2020 presidential election, before everything kind of just took off, and continued to move up, and obviously continued to appreciate through 2021. We had this uncertainty period, um, and, uh, and so those marked some pretty key support levels. And sorry, my mouse is going crazy right now. Uh, and um, and so what I did was I took the top of that range and I made that a support region. And then I took the bottom and I made that a support region. You can see on the S&P, the yellow box was a support right before we had the crash, in January and February of 2020, before we started coming down in price. It was also resistance in June 2020, and then kind of a resistance support area in July 2020 before we broke up. Um, so you can actually see how close we are. If I zoom in now a little bit, you can see that how close we are to that green line, that green box. Obviously, once we get down to that green box, we're hitting 25% correction on the S&P 500. If I were to go and turn back on my SAMS indicator, I typically watch it on a 3-day chart, although on my newsletter I show only the daily. Um, I think a better long-term picture is the 3-day using the SAMS indicator, and you can see we are still bearish, and I mean, it's just a matter of time before we hit this box. The real question for me is zooming back out. Um, are we going to hit our pre-COVID high? There are lots and lots of different equities, stocks that have come back to or below their pre-COVID high, and then many have come below that, and there are even some big equities that are even getting close to their COVID lows, making some big declines in price. So obviously, we're definitely going to hit this top box. The question is, um, are we going to catch support at our pre-COVID high? Are we going to catch support at the lower yellow box? My money says that we would that the lowest we will go. Okay, for now, I would say the lowest I think that are going to go, because I think it could take some time to get there, and I think that a lot of things will be breaking before or by the time we get this low. But I think that we're likely to hit the yellow support box here, which would bring us to more than 30% down on the S&P. I don't have a timetable for that. My guess would be by Q3, maybe into Q4. It may even take longer, but that's kind of where I'm at there. If we look at the Nasdaq, we kind of have a similar formation, although I mean, as far as like the boxes and stuff, but obviously the two boxes are above our pre-COVID high because the Nasdaq and the tech led in the post-COVID boom, obviously with QE and easy monetary policy. We've already come below the green box and we're getting ready to touch the yellow box. And then you can see here I've got the line going into the COVID lows, um, uh, or the COVID high, or pre-COVID high, I should say. We've got that right there indicated. Continues to be bearish, and so obviously this is something else that I'm watching. I think that by the time we get to the end, we will have gotten to the top of our pre-COVID high. We might have even closed below it. Again, the Nasdaq is coming off essentially at a rate similar to its increase post-COVID low, and so obviously it's down below 30%, off 30% off its highs. If we get down to the pre-COVID high, that'll be a 40% drawdown, and I think we could get there. We'll see, but I think we could get there. On the Dow is the only one, like I said, that has not hit 20% on a closing basis. You can see that it's a little bit more strange, because the green box that we're about to hit is our pre-COVID high. and that high is coming in just south of where we are right now, about 700 points lower than where we're currently at. Um, and then our little, I actually need to adjust this yellow box right here, but we've actually got a, let's see if I can find this. Why my mouse isn't touching it here, but I'll adjust that later. But you can see that kind of area gets a little bit strange. It also coincides with some 2019 levels. Um, but if we were to come down that far, we would be at 25% on the Dow. Um, and again, the Dow is, I guess, if you want to call it outperforming, it's outperforming as things are coming off because it underperformed on the rise. And so obviously, those are the levels I'm watching. First, the green box, which we're going to hit it, and then the yellow box, and then the Russell is down almost tick for tick with the Nasdaq on a percentage basis. We've already, I mean, that this was a very odd chart. You'll notice I don't have a yellow box because there wasn't really a solid place to put it. Um, Maybe possibly down here at this September low. You can see that we've already closed below our pre-COVID high on the Russell, and so that has given everything back from the recovery from uh, not from the recovery, but anything beyond the recovery back to the all-time high post-COVID. Everything has been given back now on the Russell. Obviously, the Russell was the biggest underperformer for a lot of this, outperforming for a period of a few months and then underperforming all across 2021. Um, and so um, I think that obviously I mean, we've touched the box here. I think we're going to get down to about 1450 and perhaps even 1400 in the Russell. And if we get down to that level, then we will again be about 40% down, just like with the NASDAQ, if we get down to all those levels. So those are the levels I'm watching. The Fed has not shown any indication that they're going to rescue the markets at this point, because again, they are just concerned with fighting inflation. Um, and and I don't see any reason to think that they're going to change their tune. Jay Powell discussed all sorts of different possibilities for the next few meetings, depending on data. So if inflation continues to be hot and doesn't show any semblance of coming off, and we're going to need to see not just the decline in next month's CPI, but at least 2 or 3 consecutive declines before they choose to keep things low. If inflation surprises to the upside again, it'll be another 75 basis points or possibly even 100 basis points. That Jay Powell talked about they would be in the 2 range before the end of the summer. And if you remember a few months ago, they talked about being comfortable with taking interest rates beyond neutral. And so they are not at all concerned about rescuing the indices or the equity markets at all, just any of the markets in general. Um, what gets interesting is when you start looking at some other things like the U.S. dollar, which came off really hard, had another increase, had a really deep correction again. And if you look at the SAMS indicator, then we toyed a bit with bearish, or I'm not with bearish, with neutral SAMs, and then we are back to bullish. I'm looking to see if we are going to continue the increase. Obviously, a lot of the strength in the DXY is coming from the decline in the Japanese yen. Not all the other currencies are cooperating as far as those in the DXY basket, particularly the euro, but that's going to be something to watch. The dollar index being strong is in part a result of the demand across the world for dollars because of the way the financial system is set up. But that's obviously like a strong dollar is not necessarily a good thing. And so that's something to watch. The 10-year yield switched to neutral SAMs on the last few days. A lot of people are wondering, are we peaking? As far as I'm concerned, we just made a new higher high and have retested that breakout. So what I'm watching for is, are we going to come back down below this level? I don't know why that just did that, but basically below that level. Are we going to close below? If we do, that'll be a fake breakout. So definitely going to be watching that. And then the reason why this all matters is because obviously the credit spreads, which have blown out to uh, over 500 basis points on the spreads, obviously we haven't hit levels that are even close to um, our COVID high. But as you can see from here, it doesn't take long for that to happen. We have not hit our um, Powell pivot high, although we are very close. We're less than 50 basis points away from that. Um, what was really interesting, I talked about this a bit. I was on the log chart the whole time. Whoops. Um, Still, that's okay. Everything still applies as I said it. Um, it was really interesting because there was a moment where it looked like we were going to cross below the 0% line, and I think on an intraday basis we actually did on an inversion again. And I was kind of being facetious on Twitter. I was like, so what does it mean if we cross a second time? Does that even matter since we already crossed once? Um, and so that's definitely something that I'm going to be looking into a little bit more over the course of time. But in any case, the yields are definitely something to watch, as well as the US dollar index. Taking a look really briefly at gold. Gold just continuing to act very strange given the environment coming up and being on support. As I talked about that last week in last week's video, came down, had a really awful day, down more than $50 in one day, kind of came back up and then kind of sold off again. So on the week we were down and engulfed the previous weekly candle. So it's not a very bullish thing for gold, um, but definitely is something to keep watching. And then oil, a lot of people looking for oil to roll over. Again, this is something I've talked a lot about. When the markets are increasing, everyone's always looking for tops. When the market is decreasing, like in the Bitcoin chart, everyone's always looking for bottoms. Um, and let me go back to oil, sorry. Um, a lot of people looking at this and saying, oh, this is oil finally rolling over. I don't believe so. I obviously think still the macro, the big picture still says oil has got a lot more to go. Oil, the way I see it and the way a lot of people see it, is oil is going to be the last thing to come off, to sell off hard in recession. Um, I think this is going to be your last significant pullback. Now, I'm not saying that this is the bottom of this pullback. We could come down, maybe even retest 93.53. We could retest 102. It could come down a little bit lower, but I think this is going to be your last dip opportunity to get oil at this level before we get up to another new all-time high. I think we're going to, I don't know if that's technically a new all-time high. I have to go back all the way back here, all the way back here, just to see. So no, our all-time high is up close to 150, so I apologize for that. But in any case, I think this is going to be your last opportunity to get oil below or at these levels, and I think we are going to get over 150 before the end of the year. And the big concern, obviously, is as China continues to move out of shutdowns and lockdowns, and their demand comes back online. Obviously, we have the situation with Russia, Ukraine, and all of the problems there, the lack of development. I just think that in the end, or we haven't even gotten to the part of the summer where energy usage is at its peak, and we haven't gotten to the winter when Europe needs tons of energy for heating purposes. And so I think that, I mean, and that's not just oil in that last part, but just the idea that energy and anything related to energy is going to continue to move up. So I think that this is a good dip opportunity to buy on crude oil, whether you buy futures or if you're buying ETFs or anything that is a proxy for oil. And then the last thing I wanted to talk about before we get out of here is the VIX. The VIX is interestingly, we had VIX expiry this last week during the FOMC meeting, and it's interesting to me that we have continued to not peak any higher than these wicks or close any higher than our high close was in March 7th of this year, on this little move. But then you also are noticing the higher lows that are being put in, and so we're starting to get squeezed in here. And Um, and again, I don't think that we're at the bottom yet because the VIX doesn't, I'm sorry, equities and bear markets don't end with the VIX at this level, and without the VIX spiking. Um, and you can see that in any of our periods of time where we've had like significant, bottoms and things like that. Look, I still have some data on here from our from the Great Financial Crisis. But I still continue to bring this up, and maybe it's good that I have all these up here because I want to show you how just because uh, the VIX isn't peaking doesn't mean we don't still have lower to go. Because as you can see here, um, we had a long time, like almost a year took place before from when the market peaked in 2007, before the Great Financial Crisis, before the Lehman collapse, and then it took another 6 months to reach market bottom. And you can see what happened on the VIX post Lehman collapse. So, and then what's unnerving to me is that the VIX was making lower swing highs through that time before the Lehman collapse. And so, just because the VIX is, let me go back and do this here. Just because the VIX isn't making higher highs is no reason for celebration. So I think that everybody needs to be careful, um, and you need to hedge if you haven't already hedged for more downside. More downside is coming, um, and I think that it's going to be for some time. Um, oh, I just realized we're not going to end on the VIX because there's one thing I wanted to show everybody. Let me turn off my drawings for a second so that I can put this up. I've developed this indicator called the MRT, which is the multiplier and reduction tool. And what I like to use it for, what I've been using it for, is to measure Bitcoin. And the long story short is that we have kind of a center line that is essentially a 1-year moving average. Um, and then what we have is multiples to the upside. So each color represents a multiple, and then we have the reductions to the downside, which coincide with similar calculations, but calculating to the downside rather than to the upside. And I've posted a lot of tweets about this lately, but the thing I wanted to really point out to you is that this tool has shown you, even going back to the pre first halving post 2011 peak, um, the third, I call it the third reduction line, which is again a third multiple, a third reduction down from the center point, which is obviously this white line. It has marked the bottom every single time. Um, and so if you go to the 2014 and 2015 bear market, we kind of came below it on an intraday basis, but on this 3-day chart didn't close below it. I think on a 1-day we probably did, right? But that was the bottom. And then when you come forward and you look at the 2018 bear market in Bitcoin, that was also the bottom. And so I know a lot of people have done a lot of different things to try to track market bottoms, but this is for me kind of the big one. And again, Bitcoin has not been through, I mean, while it has been through quantitative tightening, rate raising, and all that, it has not been through a period of high inflation where the Fed was focused on fighting inflation above all else and not propping up markets. However, I do think that is it's entirely possible that this area could be the bottom. And right now that level is coming in at 17,358. So obviously, if you want access to this, or if you want to see this metric, then you can follow me on Twitter. You can become a paid member on my newsletter. You'll get access to this as well as my SAMS indicator. You can find that information on my Twitter at Mr. J. Thomason. But that's where I want to leave us for today. So again, be safe out there. I hope you guys have a great weekend, a great rest of your weekend, and that you have a good, safe week next week. Thank you for watching.